If you are unsure which direction the market is going, I have some options.
Hey, it's Rosh from Spy Tomorrow. I know what it's like to be a trader, watching the market, looking at indicators, and still wondering which direction is the market going to go. And we like to do overnight swing trading, so we wonder the night before, which way is the market going to go? And sometimes our indicators are all over the place. Sometimes they really don't give us a clear direction. So what can we do? Well, let's talk about straddles and strangles. So with options, straddles, and strangles, you don't have to worry about predicting the future all the time, which can lead to less stress. So in this video, I'm going to show you exactly what they are, how to buy them, and demonstrate some real-world results. And of course, you need to know what to look out for and if there's much of a return. So a straddle looks like this. You buy a call and a put at the exact same strike price with the same expiration. So basically you're saying, I don't know which way the market's going to go. I have a call, I have a put, and if the market moves enough, I'm going to make money. But it does have to move enough. Now here's the thing. You don't have to hold that straddle until expiration. You can sell it the next day. So as you can see in this example, it's the same strike price and actually the same expiration. However, I placed the settings at 16 hours ahead of time. And as you can see, we don't need as much of a market move overnight to make a profit. And of course, if the stock doesn't go anywhere, over time, theta will chip away at that premium and you will lose money. So what if there's another way in which you don't have to put up as much capital, but could benefit from a big move either direction in the market? And that is what we refer to as a strangle. Buying a call and a put at different strikes, but the same expiration. Out of the money, so they're cheaper. Let's take a look. So this is what a strangle looks like. So rather than buying a call and a put at the same strike, you buy a call and a put outside the money, but at an equal distance, which can decrease the premium quite a bit. Just like with the straddle, you don't have to wait until expiration to sell these options. And like the straddle for an overnight trade, your stock or ETF doesn't have to move as much compared to having to wait till expiration. In this example, the calls and puts are about 5 points outside of the neutral point or where we had our straddle. However, you can make them any length you want. They could be 1 away, 2 away, or 10 away. It's up to you, your budget, and how far you think the market just might move. Now let's take a look at some real-world examples. First, let's do an example of a straddle. And this is an example of an overnight trade with an expiration 4 days out. Now, a traditional straddle would have the same strike price here at $291. However, the difference is enough that I would want to actually go down to the $292 because the prices are more equal. And many traders will still consider this a straddle. If I stuck with the $291, in a way, I would be leaning upward in my setup bias. So the cost would be $1,044. And I'll show you a strangle in a moment, but first, let's look at the results. So the next day, about 1 minute and 30 seconds into the open, this ETF was down about $3. So based on the bid prices, you would receive $1,048, maybe a little bit more if you could average between the bid and the ask. So for the most part, you end up about even with a few dollars profit. Looking at the strangle, we went $4 out of the money for a total of $6.80 or $680. Taking a look at the results, again, there was a $3 move, would be $686. Divided by 680 is better than the straddle, but not by much. And of course, if you could sell a little bit better between the bid and ask, your profit would increase by a few dollars. These next examples of a straddle and a strangle have a contract expiration of 7 days. I may not have mentioned the other example was the QQQ. This example is SPY, and the move is 1.5%, where the QQQ is a move about 0.5%. So as you can see here, I did the same thing. I took the 366 and the 367 for our straddle. And the cost is $1,017. So what was the next morning result? As you can see, it was a nice move, and the morning value of these options is now $12.75, a profit of over 25%. Now let's look at the strangle. So for the strangle, using the same data, 7 days until expiration, I would buy the 370 call and the 363 put for a total of $656. So with that big 1.5% move, the options are now worth $909, which is a gain of 38.5%.
So which do you prefer, straddles or strangles? Let me know in the comments below. As you can see from those examples, you can make money in the short term with straddles and strangles. However, you do have to keep an eye on a few things, such as volatility. Now, we think volatility is great for options, and it really can be. However, when that volatility is coming down, overnight, the value of your options could drop like a rock, and you could lose more than you expected. And of course, this is true with any long options play. However, some people like to create short straddles and strangles. In other words, letting the time decay of theta work in their favor. As you can see here, if the stock doesn't move very far, you can make some good money. And the same goes for the strangle. Hold on. Let's look at those graphs again and notice something really important. Let's look at the straddle. This is the long straddle. And as you can see, the max gain is infinite. The max loss is well defined, how much you put into the market. However, when you sell a straddle, you have the reverse, where there is a max profit. However, the loss is infinite. And that is why I never suggest people sell options unless they have the securities or the finances to back it up. And of course, most good brokerages won't allow you to do that unless you qualify. So if you think there's going to be a big move in a stock or ETF, well then consider a straddle or a strangle. It doesn't matter which direction the market goes, it just has to go, which if planned well can lead to some amazing results. And I'll see you in the next video.